Okay, there we go. Now it should be sharing my screen. So I was just showing you guys here in the trading course that we have the updates to the charts and technical analysis, which is great for you guys. Technical analysis, of course. We have 2 pages, so don't miss out on the content that's on the second page. If you look down here, it'll say 1 of 2 or 2 of 2. So right here we have 2 of 2. So if you go back, then it'll say 1 of 2. So make sure you're not missing out on any of that content. And then again, I know I just said this, but I wasn't sharing my screen. So if you scroll all the way down to the bottom of your trading course, then you have the webinars. So if you don't get a chance to see them live, you can always watch them here. So that being said, we'll go ahead and get to our presentation. Today, we're going to be talking about risk management. So I got a few slides here, and I'm going to be doing quite a bit of talking at first, and then I will get into show you what these steps actually look like on a chart so that we can track them and see what a proper risk management scenario looks like. Now, before I get too far into this, I just want everyone to understand that there's definitely a lot of different ways to interpret risk management. I'm going to be laying out basic guidelines and principles just so you kind of have an understanding of what a proper balance should be whenever you're looking to be trading. Now, I'm not to say that I follow these rules all the time myself. I don't think that any one trader does follow the rules 100% of the time. I'm going to explicitly say that you should try to keep your risk management system as organized as possible and consistent as possible. But I'd be lying if I said that there were times we didn't step outside of these lines to try to make better position, and that could be more profitable or painful depending upon what the market actually looks like. So again, I'm going to go through the basic guidelines of how we should be managing our risk, and then we can talk a little bit about how to go outside of those guidelines and what scenarios we might look to step outside of the lines. So, basically, we have been going over a lot of technical analysis in our previous presentations. And again, if you missed those, they are in the webinar section of your trading course. So whenever you have a little bit of idea of how to interpret price action, then you are wanting to get out there and start making trades. But if you don't have a proper structure for your risk management system, or if you don't have a risk management system at all, then you could be going out there and blowing a lot of money because you think a trade is going to win, and you might be putting too much money into the trade or not have a proper management system at all. So there's 2 different ways to look at it. I'm going to be talking objectively about both of them because some of us only trade spot and some of us only trade futures. What we should be doing, and again, this is just general guidelines, we should be trying to trade both spot and futures. It's easy to trade futures with USDT and other contracts so that you can go long and short without owning the coin. But on spot, it's beneficial to try and multiply your Bitcoin. If you have some on a separate wallet, like a Ledger wallet or what have you, you shouldn't even be thinking about that. Whatever you have offline in a cold wallet is not to be messed with, not to be disturbed. You should be accumulating that for your future. But whatever coins you have on exchange, you should have a plan to utilize them, because money laying around isn't doing anything for you. You got to put your money to work, right, in order to multiply it. So whenever you have your trading bag separated, typically I like to have about 50% in Bitcoin so that I can trade Bitcoin to other pairs like Bitcoin Chainlink, Bitcoin Theta, things like that. And then I like to have USDT so that I can trade, the dips and movements in USDT markets, like, of course, USDT Bitcoin, Litecoin, things like that. You don't want to mix up the 2 percentages. You want to kind of keep them away from each other. So we'll just talk about USDT to make it easier for everyone to understand, but be aware that you should have Bitcoin as well in your trading bag, right? So objectively speaking, from your USDT bag, I would just like to make it for easy math. We need to check our net liquidation price. So what is our net liquidation price? That's very easy. Once you log into your exchange, wherever it is, all you have to do is check how much capital you have, right? It's not that difficult. Step one is just to observe how much available capital or funds that you have to trade with, right? So that's going to be helpful when trying to determine your position size per each trade. Step two is you're going to need to determine your risk per trade, right? So here, risk refers to the maximum loss that you're willing to take per trade that you place, right? Which is a stop loss. This isn't step two. It does not mean how much of your portfolio or how much of your balance or funds you're looking to use per trade. This is going to be your stop loss per trade. I was just talking with somebody in the private group earlier about the most important, or what I consider the most important part of a trade. He was asking others, and a lot of people were saying it was stop loss. And for the purpose of this presentation, we're going to say yes, stop loss is very important, and we're going to look at how to set them consistently so that we can delete variables from our trading game, right? Because the market has plenty of variables for you already. You don't need to be working against yourself, altering your variables, right? So the risk refers to how much loss you're willing to take per trade. So this is the maximum you can lose if your stop loss is hit. I would generally say that it's not a good idea to risk more than 3% of your capital in any trade, or 3% per trade. So I'm going to pull over to my chart and show you what that looks like. So right here, I'll go ahead and full screen this for us. So right here, I've got this little graph laid out. I was running a little bit of a demonstration just a few moments ago. So here in this risk reward, let me see if I can delete this one. It seems to be stuck. Okay, there we go. So here we have a basic risk reward chart. Here we can see, let me get it away out of the candlesticks. Here we can see 1%. If we were going to raise this up, we can make this a proper 1-to-2 ratio, which means we could see about 2% reward for 1% risk. See if I can raise it up just a little bit more. There, so that's about a 1-to-2 ratio. So we can have 1% loss for a 2% reward. If I wanted to bring this down and extend this to 3%, so in any given scenario, we're only willing to lose 3%. This is how we can determine how much we're willing to lose with a plot right in front of us, so we could see what our risk to reward ratio is. So generally speaking, if you're going to have a 3% stop loss, you're going to want to have at least a 3% take profit, right? So you can at least go 1-to-1 on the trade. Depending on the trade setup situation, and once you gain some experience, of course, you may want to opt for more stop loss at the potential for more gain. If you want to bring this down, 10%, that could get you hurt in some scenarios, depending upon what you're using. But in other scenarios, it might be absolutely achievable. Right now, we're looking at Link BTC. So if we set up this 3% to 5%, it wouldn't be very often that we had found this in nature, right? Let me go ahead and extend this so it makes a little bit more sense. Sorry about that. Pinched out of there. It wouldn't be often that we found this in nature, so we would have to set that somewhere where we would find support in a previous range outside of our stop loss, because here, this is achievable. This is an achievable stop loss, right? If we were to put our stop loss outside of this range, let me go ahead and put a line so that we can see that. But that's an achievable stop loss. Even here is an achievable stop loss because we've seen price come to this point before. So if we wanted to enter at that point, we'd be looking at 6% stop loss to be a good stop loss. Otherwise, price could come down into this range and we could get stopped out. If price came down into this range down here in the red shaded area, we would get stopped out of the trade, right? Past here, this would be our stop loss. So this is our profit that we are risking, which is 4.93% for a 6% loss. So even if we raise that to here, which is a swing high. So if we were going all the way and targeting all the way on this position here, all the way up to our swing high, and we raise that, then we would be looking at a more reasonable trade that's about 6% loss for a 7% gain. So that is not bad. Now, there was someone who was just asking me, it was Ethan in the lobby, he was asking me why I prefer entry over stop loss, because here we can see that we have plotted our stop loss, right? We have a reasonable stop loss in sight. So this is a swing low. We can see that if price goes beyond this point, it's more than likely going to continue to go down in this direction. So to avoid losses there, we would use a stop loss, right? Now, if we change our entry, see, if we would have got in here, this would be our risk to reward ratio. Or if we were just jumping into the market right now at the current market price, you can see here, let me zoom in a bit. If we were just jumping in at the current market price, we would see that our risk to reward ratio has changed. Now it's at 5.24% gain for a 7% loss. So if we can wait and plot and time our entries, let's say that we've seen a recent swing low to here. So if we can plot our entry to come back for whenever price comes to right here, this is in Satoshi, we're looking at Link BTC. So whenever price comes back here to 0.0005299 Satoshi, that's a very ideal entry. Is it possible? Perhaps. Is it achievable? Maybe. But this is a way to reduce your risk to reward ratio, right? Because now we can see that if we plot our entry lower than taking it at the current market price, we have a better opportunity to make profits, right? So we adjust this. And if we could come and get an entry here, well, then it makes our risk to reward ratio look a lot better. So I'd like to take a look at another example so that we can see this and see what I mean by the stop loss guideline. Because like I was saying, before I get too far into the example, 3% is ideal. So let me show you how we can lay this around and find ideal opportunities for us. So let's just keep that at 2.97%. And then we will keep this. Let's say if we can go 1-to-1, we're either going to make our money or we're not going to make our money in this trade. So we'll keep it right about there. This is what we're going to be looking for. We need to find this opportunity. So actually right here where we are is a fine opportunity. If we can move this back just a little bit and we could say, or move it forward, because let's say we're actually looking at this current price scenario. If I can get an entry right here. Okay. That's pretty good. See, so right here we have a recent swing low that is within our stop loss range. So now I can extend that over actually so you'll see. See, this is within our stop loss range. So we have a 3% stop loss, the one that we were looking for. And we have found a formidable opportunity to say, okay, you know what? Price could come up and I could hit my take profit because price has come up past it here and it hasn't come down through this stop loss. So laying this little dealio around our little long position finder, we can find opportunities that we like to take. Now, like I was saying, generally, I don't want it to be more than 3% if I'm using a stop loss. But if you have different intentions or different reserves on your funds, you can reduce this, of course, to whatever you like. If you want to be a 2% trader, there you go. You can keep it 2%, or if you want to keep it as a 1%, really tight stop loss, you say, okay, I don't want to risk more than 1% on my trade, but I still want to make at least 2.5%, right? So this would be an ideal reward to risk ratio for me. Or, just example, another trader, he doesn't want to go 3%. She doesn't want to go 3%. She wants to go 1%. So now we have this risk to reward finder. We're going to drag it around and see, okay, well, to avoid too much exposure, if we go past this, I'm going to want to be out of the trade. So now my entry is going to have to be here. I'm going to have to change my desired entry. I'm not going to be able to jump in soon, or because I think I found an entry price, I'm going to set this up. This is how I would say lay your chart around to find ideal opportunities. Because if you have a 1% stop loss here, and oftentimes people get stopped out of their trade undesirably. So if we can use other additional technical, sorry about that, I didn't mean to zoom out there. If we can use other additional technical analysis factors, like laying a trend line here. I'm not going to go too far into technical analysis here because we have been over that quite a lot lately. So now we have this trend line here. I'll just go ahead and draw one more so we can see this wedge is obviously playing out. So we have a wedge outbreak attempt here, and we would like to find our 1%, which is ideal. So if I was laying this down here now, like I had tried to a while ago, we might not be able to take this position, right? Because if price follows along this trend line, our ideal entry may be missed. So we might not be able to take this position if we desired to get in at this price point where my cursor is now, because obviously this trend line is extending up. So we would have to break that trend line, come down for an entry, which at that point might make the trade invalid. So there's a lot of things to consider whenever we're doing this. If you do want to play it super safe and this was your ideal entry, it is better to miss a trade than to get in at the wrong time or at the wrong projection. If you simply, get into a trade here, if you try to panic buy in thinking that you want to get your, 2% or 1%, whatever, at the wrong time, thinking we're going to follow this uptrend, then you're going to lose out on the trade. So make sure you know how much you're willing to risk before you try to set it up. Moving this around now, we can see this might not be a bad time to enter if we can adjust this up, keeping the same parameters, right? We still have our same ratio. We haven't changed the percentages. We just moved our desired entry because entry makes a big difference. So if we keep our risk reward ratio the same and move our desired entry up, now we can see that we're still within a nice stop loss range here, which is our 1%. And we might be able to find an entry here along our desired entry, right? Because where the green and red separate, that would be our desired entry, which is at this point right here, 0.053849 Satoshi, or 0.00053849 Satoshi. So that is a possible and plausible entry. Price might come back down, reject off of this 200 EMA, and we might be able to see an entry here while continuing along this trend line for a valid setup. Now, you can probably see that without that risk reward ratio there. But then you would have to be setting up blind, and you might say, okay, well, I'll set my risk to reward, or I'll set my stop loss here. I'll buy in right here and then set my stop loss if it comes down 2.16%. So you have to try to objectively have your stop loss plotted before you get into a position, because then you'll start to get a biased opinion about where your stop loss should be, and you could be losing money for no reason. So that's just a brief example of how that works. And then once we can determine our risk per trade, excuse me, guys, I'm going to get a drink of water. All right. So once we can determine our risk per trade with our risk to reward ratio, like I said, if you generally want to set it no greater than 3%, 1% really if you're just learning how to trade, and then try to find where you could set it in a reasonable zone like we just did. But once you do determine that, then you'll want to determine your position size for the trade. Now, based upon where you have it set up at and how much technical analysis you've done, how many confirmations you can find, that is where you will be able to play with your variables more often. So a lot of people try to risk or adjust their stop loss outside of a expected range. They're like, oh, okay, if it goes here, minus 7%, then I'll get out, which is, not exactly ideal whenever you can control your position size. So you could be losing a lot more money if you are trying to put all of it into a position that isn't properly analyzed. So once you have done your technical analysis, and then you have determined your risk to reward ratio, what a reasonable risk to reward ratio is for that trade or position, then you can see how much do you want to put to that trade. So, ideally, I would say not to risk more than 10% of any of your available funds for one single trade. If you're feeling really good about a trade and you think that, oh man, this trade is going to be a grand slam, it's going to be a home run, this is the trade that's going to change my life, you should probably only put 10% of your available funds on that trade. If I'm feeling really good about a trade, I would say 10% is exactly enough to help yourself in a later situation. Carrying on from that conversation I was just having with somebody in the Telegram group, was that the entry, of course, was important. Stop loss is important, but you have to be able to DCA in some scenarios, right? If you plan to DCA, you don't actually need a stop loss. So I'm not going to get too far into the DCA scenario in this video, because we are talking about risk management, but it is possible to DCA your position if you're not using it all. If you have 85% of your, if even 50, if you have 50% of your funds in a trade, then it becomes increasingly difficult for you to buy more of that asset as it lowers to average out your price. Just because you buy more of it at a lower price doesn't magically mean you're going to save yourself, right? Just because you know how the DCA works doesn't mean it's going to work for you. You actually have to have funds in order to reduce your take profit goal. So I'm not going to get too far into the DCA method, but I just want to generally say, and of course these rules are meant to be broken, but generally, if you feel good about a position, don't put more than 10% of it into the trade. So that way you have more funds, of course, later to make other trades in case that trade goes against you, and in order to bail yourself out if you need to. So as you gain experience and develop as a trader, you might grow more confident placing more of your available funds into each trade. That's okay. It's your portfolio. Ultimately, you are in control of your risk and reward ratio. So it's all up to you. Just keep in mind that any investment you make, could result in a loss. It's not like every single trade that we are going to make is going to be a winner. We just have to be strong enough and confident enough that we have the funds to preserve ourselves over the larger sample of trades. For example, if you have made 100 trades, maybe you want to win at least 60 to 70 of them and have lost out to 30 or 40 of them. So keeping your majority of trades to being winners, or avoid being stopped out, so that way you can take a profit, is the goal here. It's not possible. At least I don't believe it's possible to win on every position. Sometimes we end up losing or taking a loss. So just keep that in mind whenever you are trading. And I would always advise to be conservative in your trades. So moving forward, we're going to talk a little bit about managing leverage. So I just want to talk a little bit about managing leverage, because there have been a lot more futures competitions lately, and some of the guys are trying to get in there and trade futures, and a lot of them are running into some problems. Sorry about that. Let me see here. Got a call. Are we still live?
Yes, we are still live.
Okay, perfect. Sorry about that. That call interrupted my screen. So we've touched leverage a few times. Of course, we have definitely gone over it in the trading course, but I'm just going to briefly touch it here to see how we can bring risk management into it. I'm going to discuss it how it pertains to position sizing, basically. So when you apply leverage, what you're doing is basically you're using borrowed assets to trade with. So it's not ideal for a trader who is just starting out. I know a lot of guys who are just joining the cryptocurrency space and crypto university. They want to, get into making as much money as fast as possible. So I just want to try to steer you in the right direction because honestly, if you're not good at making percentages first, then you're not going to be making much use of leverage. If you're using borrowed assets and you're not a fantastic trader, you're going to be losing borrowed assets, and that is a lot easier to result in what people call liquidation, right? Because whenever you put your funds up to, you can use isolated margin, which only allows you to lose a certain amount of money. But if you're using cross margin and your trade goes in the wrong direction, you could ultimately lose all the money that you have in your account. So just as a forewarning, I guess, try to stay away from futures if you're not a experienced trader, and just work on trading spot and gaining those percentages first. And then once you realize how to manipulate the market and you get good at technical analysis, then you can start to go outside of these guidelines for risk, right? Because basically everything that we just talked about is going to be irrelevant when you're looking at futures trading. It comes with a little bit of different risk management guidelines. It's a lot more people. Some people try not to make too much a big deal out of it. It's really not a huge deal, but depends on how much money you're trading with. You could lose it all very quickly. So basically, here is an anti-liquidation management template for you. I would say if you're just starting out, try not to use more than 20x leverage. If you're looking at these guidelines here, now this is going to be exactly the same as if you were using 100% of your position, except you're going to be using it on futures instead of on spot. So you can use these guidelines to short coins that you don't own without fear of liquidation. Of course, you'll still need to use stop loss and manage your risk depending upon how much cross margin you have. But there are different scenarios for these so that if you get into it, for example, I have on the next slide here, if we're looking at two trades with 10% funds each, that's equal to 20%. And you can take that at 5x. So if we have 20% of available funds, right, at 5x leverage, then we're going to be able to avoid liquidation. In theory, that coin would have to go all the way to zero in order for it to be liquidated. So if you have two of these positions, you can open one at a time until they get into profits at two trades, 10% X, 10% each at 5X would be equal to 20%. Or using the same guidelines there, you can use four trades with 5% of your available capital, which is equal to 20% at 5X, keeping the same guidelines right here, 20% at 5X. Now, if you step outside of these guidelines a little bit, then you can start to make a little bit more money. Of course, whenever you're leveraging your funds, now you're stepping outside of the anti-liquidation guidelines, so you can start to make a little bit more money. 10% of your funds at 20x means that once your initial margin is erased or consumed, then price of the asset only has to fall approximately 50% for liquidation, which is not exactly impossible. So the further away you get from these guidelines, the easier it is for you to experience liquidation. And like I said, using these basic percentages here with these basic leverage amounts here is going to be almost identical to, or basically identical to trading at spot with the entire balance. So depending upon your balance and how much you have to use, those are some guidelines for you to abide by, and using them in conjunction with what we had just learned to manage your risk reward ratio. So then you can multiply your anticipated market swing percentage by your desired leverage to project a liquidation price. So if you are looking at, let me go over to my exchange now. So we're looking at this trade right here. And let's say that, just for easy math's sake, let me get my calculator just in case. I want to be able to have this right for us. Okay, so just for easy math's sake, let's say we have $1,000 and we are using a position size of $100. So if we're using a position size of $100 and we're looking at this chart here, how long will it take for us to be liquidated? At what percent of leverage do we want to use? So depending upon what exchange you have, there's different leverage amounts. I think for Binance on, oh, actually, I'm not even on futures. Let me pull up to a futures account real quick, guys. There we go. Okay, so now we've got our BTC chart here. There it is. All right, it was taking a second to load up. Okay, so now in our BTC contract here on Binance, we can go up to 125x leverage, which is pretty insane. That means if we had $1,000 and we threw that entire position size into it at 125x, it means we could be trading as if we had $125,000. But we would take a percentage or loss gain on that $125,000. So if we were using 125x, we had $1,000 on there. It would only take a very minuscule price swing in order to liquidate our position size of $1,000. So the percentage loss off of $125,000 is actually, or I'm sorry, $125,000 is actually what you would be taking your return on investment from. So if we were using something reasonable, let's just say we have 10x. So if we have 10x leverage, of course, and we have $1,000 in our account, we're using only $100. That's going to put us at $1,000. So if we're using $100 at 10x, it's as if we're using our entire portfolio. Now, if we're using $100 at 20x, it's as if we're using $200. Put that up to 20x. Okay, so if we're using, if we're using $100 at 20x, it's as if we're using $2,000. So now we're going to be taking our position, our gain from our position size of $2,000 instead of the $1,000 that we have in our wallet, even though we're only going to be using $200 in the trade. So the other $800 is going to be for our margin. That's going to support us marginally. So if the trade goes in our favor and we have our position size now taking profits, we're going to be taking the profits off of $2,000. So if we take profits off $2,000, then and if we only get a 2% return on investment after we apply leverage, then that's going to be $40. If we're losing 2% on that, then it's going to cost $40 worth of margin in order to sustain. So you have to be able to chart your marginal support on a graph. So let's look to see how far we can go. Let me just put this onto the 1 hour. I think we might have a little bit more room there. I think that might be the 1 hour. Okay, there we go. So whenever you're looking to plot your liquidation prices, you can see that you'll have plenty of room to go on both sides. If you're looking for our long position, so let's say we want to get in right here. We can set up a reasonable take profit here at the 200 EMA. That looks all right. And then our stop loss would be below that point. So here, if we're using, in this example, we have $2,000. If we're looking to take a loss, well, actually, we have $200 and we're using 20x leverage, right? $200, we're using 20x leverage. So that makes our position size, I'm sorry, we have $100 and we're using 20x leverage. That makes our position size $2,000. So our position size with leverage is $2,000. So we're taking our 4% and we're going to have to minus, if we take a 4% loss, which is right here, 4.71. If we're taking a 4% loss, it's going to be $94.20. So we have enough margin to support that, right? We have $800 worth of margin. That's how we know that this is an all right stop loss. Like, of course, I said you're going to need to determine your stop loss prior to your trade. Don't do it the other way around, or try not to do it the other way around anyway. Because if you're determining your stop loss after you determine how much money you want to use, then you're going to see that you're in trouble. So before we get into this trade, if I say, all right, I'm going to take this position with, $2,000 on leverage, even though in my entire account, I only have $1,000, I'm getting to trade as if I have 2,000. If I take a 4.7% loss on this, I'm going to be losing $94. I can sustain that loss because I'm going to be risking a 5% gain, which off of $2,000, how much was that? 5.4, which is $108. So you're risking $108 gain for a $94 loss. Now, if this doesn't make sense to you, you should change your leverage amounts. If your trade looks good and you're like, you know what, I can make that take profit. I really believe I can make this take profit go work here, and that stop loss is reasonable. That's, I don't believe that stop loss is going to be hit. Then you can increase your leverage to whatever amount you say, and then redo your math. Okay, so if I can go to, if I go up to, we'll try to keep it easy on math here. If I can go to 30x leverage and I'm using $100, that means I'm going to be using a position size of $3,000. So now I need to do the math again. So I'll take my $3,000, multiply it by my deviation here, 4.71. So that's $141. Can I support that marginally? Yes. If my stop loss gets hit, I can marginally support that. That's quite a loss. I'd be looking at $141 loss for 5.42% gain. So I'd be looking at $162 gain. Now, if that looked like a reasonable wager to you, you might want to take that trade. This is just an example. I didn't do a lot of technical analysis here for this presentation. I just wanted to show you how to calculate what your marginal support is going to need to be, right? If you get your stop loss hit here, that's how much money you're going to lose. Now, if you're trading without a stop loss, then you're going to be looking at a lot more marginal support for yourself. If you're trading without a stop loss and you come down, all the way to minus 10%, then you're going to be looking at a lot more money involved than just using a stop loss. So if you know how to DCA, which I said we're not going to get too far into now, this was basic risk management principles and guidelines so that you can kind of see how to overlay a risk to reward ratio or a risk to reward system in your trading. So that being said, we have gone over the basic principles and then applied it with leverage. So you have some kind of foundation for both. I'm going to conclude the presentation with that, and we will open up to question and answers. If anyone has any questions, preferably about risk to reward or any questions in general, we'll try to get those answered right now.
Thanks for watching the video, guys. If you want to tune into these when they are hosted live, check out the link in the video description to become a member at Crypto University, and we'll see you next time.